Good evening, everybody. Week 8, Business Finance 330, live and in color from Claremont, California. The temperature, 91 degrees. My name is Rick Hassey, your host. Hope everybody is well this evening and feeling fine as we head to the last 3 weeks of your finance experience at the University of Laverne. And it couldn't be any more fuller 3 weeks. Last night, many of you have posted assignment number 3. You have an off week this week as far as any graded work, but you are probably expected or should be beginning to work on your California Best Trucks case. We'll be talking about that this evening. Then you have assignment number 4 next week, which is due August 10th. And then the final week of our class, you have the California Best Trucks case due Sunday, August 16th, along with your final examination. A lot of work over the next few weeks. To aid you in that work, we'll be doing a few things. We will be reviewing, as we have been every week, the California Best Trucks case. We'll spend a little bit of time on that this evening. I also am planning a voluntary review session for Saturday, August 8th on Zoom, beginning at the noon hour and lasting about an hour and a half. This review session is voluntary. I will post the link tomorrow to that review session. It will be a different link than your office hours and this class's link on Zoom. It will be a totally separate link. August 8th, we'll have a review session. At that review session, I will answer any questions or help any students who are having difficulties or in a panic mode for that last week. I also will have, prior to that review session, I will have an outline of what to expect on the final examination. I also will review any last minute calls for the California Trucks case. I believe I've indicated before that if you send me your WAC calculation for the California Best Trucks case, I will approve it and make sure it's okay so you can move forward. If you wanted to calculate, and some students have already done that and send it along to me. Also, if you want to, this is something new, if you want to send me your base case analysis for one of the products, not both of them, but for one of the products, they're fairly similar, I will let you know if that is on the right path. I won't indicate the exact issue of your work, but I will tell you yay or nay and where you might want to look at to clean that up. So you can send me via email your WAC analysis, and after that, your base analysis for one of your products. I will review them and let you know you're on the right track. I strongly urge you in this timeline this week, since we don't have no graded work this coming week, that you begin to put together your California Best Trucks spreadsheet. And I'll give you that checklist in just a moment. Because after next week, you have, in addition to the trucks case, as I said earlier, you have assignment number 4, which is on 6 chapters, and you will have a final examination, which is on 15 chapters. Of course, you'll be getting a review sheet for that. You'll know how to prepare, but still, that's an awful lot of material, especially it's summertime, we are remote, and you probably have some other classes to deal with. That's a lot on your plate for this year, this term. So plenty of warning, plenty of help if you need it, and we can move forward. I will not go over the assignment 3 tonight as a review because we still have some students who have yet to post their work. I will be grading assignment 3 tomorrow and posting the grades to the students who have completed their work along with the solutions to their grade center. The reason I want to get these grades to you as soon as possible because assignment 3 is a good practice for the California Best Trucks spreadsheet work. So the quicker you get that back, the better you can move forward and begin to tackle that assignment. So look forward to that tomorrow. Couple things to note in regards to assignment 3 and the California Trucks case. If you go to your Blackboard to week number 8, there is a checklist of how you should plan your attack of completing the California Best Trucks case. Also, there's this spreadsheet from last week, which probably many of you used for assignment 3. That's a template for this work, a template to complete a capital budget analysis. That's something you should be familiar with and have as at your recall very quickly in your work as you prepare this California Best Trucks case. Also, assignment number 3 will be a template for the California Best Trucks case. But here's what you should be accomplishing in order to finish your work for this case. First step is to calculate the weighted average cost of capital. Second, what is the initial year investment? How much are you investing in year 0? Then you put together the yearly net project cash flows. I'm going to talk about that in a little bit detail in just a minute. Then you provide the additional cash flows after net income. Depreciation, if there's salvage value, working capital. Then you do your return analysis. You've all done this in assignment 3. Then you come to your conclusions and you answer the 6 questions that are asked in the case. That's the basis for your paper. Now also in Blackboard, if any of you have never done an APA format paper before, I have a video which explains the APA format right here in week 8. But the APA format basically is, and I also have given you that in your other files about the California Best Trucks case, is that I need a title page with the appropriate information about this course in your name, an abstract page where you state what you're trying to do in this case. Now remember, this is a case for a company called California Best Trucks for a CEO named Michael Livingston. He believes that now's the time they should provide bus transportation in the market. With the state of sustainability, air quality, energy, population, the market, California Best Trucks now believes they should be producing a mass transit bus and sell it to the market. The determining area why you're brought in with this case is which bus should they create and sell? Should it be a bus with a Los Angeles engine, or should it be a bus with a California engine? And that's what you're recommending to Mr. Livingston. So your options in your abstract are A, so I recommend the Los Angeles engine bus for you to produce and build. Here's why. Option B, I recommend the California engine bus to produce and sell to the market. Here's why. Option C, you know what? Excuse me, ladies, they both suck. I'm not recommending either of them. And here's why. Option D, you know what? They're both fine. They're both providing an adequate return. They both are dealing with the risk in the market. I recommend both of them, Mr. Livingston. You pick. So there you go. That's your options of recommendations to Mr. Livingston at California Best Trucks. That's what you need to explain and interpret in your case paper. By answering those 6 questions in that format, you're giving me 2 files, a written format, the paper explaining your answering those 6 questions, and the exhibits of the spreadsheets, showing me the analysis for the LA engine and the Californian engine and how you calculated the weighted average cost of capital. Very similar to what you did in assignment number 3. The only thing different is the names have been changed to protect the innocent. You have to figure out those names. Now, I know some of you will be sending me your work and I can review it, but I also know some of you might be using your University of Laverne network within this class or outside of class to solve this case and get help. I have no problem with that whatsoever. But you need to reference it in your paper. If William decides to go to hang out to talk with Ashley, and William says to Ashley, hey, what did you get for whack? Ashley says, and William goes, that's not what I came up with. How did you do it? Show me what you did. And they both come to the conclusion that William was right, or Ashley, whoever. If you do that, you have to list that as a reference for your paper. If Edith sends me her WAC calculation to Professor Hassey via an email, Mr. Hassey, is this right or wrong? And I answer back, Edith has to put that in on her references for the case. I contacted Mr. Hassey. He was an advisor, mentor, whatever, for the WAC calculation. Don't do this, and I find out that you got help and didn't record it on your references, you're going to lose 10 points right off the top of your paper. I keep track when people send me the WAC referral or the base case referral. I keep track of that. And then I'll say, oh, Edith, I better see when I open up Edith's paper in her references, if I don't see Mr. Hassey as a reference, Edith loses 10 points. Ouch. That's tough. In academic study, even at the undergraduate level, professionalism, ethics, accountability is part of the academic discipline. Wait till you go to graduate school, if any of you go. So you have to be accountable for how you did the work. If it didn't come, if the answer did not come from your brain and you sought guidance by interviewing Professor Hassey, talking with fellow students, or talking with former Professor Hassey students, nothing wrong with that, but you have to include it in your paper. If you're not, you're being academically dishonest. Okay, everybody understand that? Cool. Then it's really pretty obvious. You look for help, you have to include that help in your reference. And you won't be I wouldn't think very kindly if William puts down, geez, I asked this guy for WAC, I asked this guy for investment in the initial year investment, I asked this person for the yearly cash, if you ask everybody about all those points, I'm going to think, William, what's up with this? But, sorry, William, to pick on you. Reason why, because I can see you. So, show some, discipline there, but I have no problems you guys seeking help elsewhere, from me, from whoever. A lot of students in the past have used study sessions, get together on a Sunday via Zoom or something, or via chat or some chat things or texting, and they go over things. There's nothing wrong with that at all. You don't think they do that in the real world? They do. as long as you're accountable for it and tell people what's up. That's all I care about. Okay? Simple as that. Okay, so here, this is a good checklist about things you should accomplish in row. Right now, this next week, you should probably get down to at least question or point 4. Get that out of the way this next week because you're going to be snowed under the last week or so of class if you wait till then to do this. Trust me. You're going to get snowed under and then you're going to work through it fast and you won't be as efficient, as accurate. Okay. So I just explained the California trucks case deal. You are helping the company, California Trucks, decide on what they should do about a new product in a new market. What's the market? Mass transportation. The very first question in the case is, does energy situation or does energy cost market play a role in making this decision? Well, I'm going to tell you the answer is yes, it does. I'm looking for you to explain that. Why would a company want to build a mass transit bus? Because they feel in Southern California, there's a market for that. That's an important thing. Now, why do they feel that? That's the answer to question 1. So you're going to have to do a little research. And then we get into the problem. What's their cost of capital? What's their cash flow? Blah, blah, blah. But your determination is if you begin to look at the exhibits given to you in the work. I'm sorry, I just noticed a typo. What a moron I am. You know, I yell at faculty member for being sloppy, and here I look on page 3. It says your final report due is Sunday, August 13th. Mr. Hassey, that's Sunday, August 16th, you knucklehead. Very nice. Quality work, Mr. Hassey. Quality. If you look at page 4 and the exhibit 1, there are the details to begin the analysis of this case. This is exactly like the details I gave you in assignment 3. It's just the numbers are a little bit bigger, and there's that question of the warranty. Now, I'll be frank with you. The warranty issue is the determining factor on whether you get an A or not. That and being somewhat legible and readable in your paper. But if you can figure out the warranty, that's A work there. If you notice, all the numbers are the same for both buses. A bus with an LA engine and a bus with a California engine, the selling price is the same. The units sold every year is the same. The labor cost per bus is the same. The components and parts are the same. The SG&A fixed costs are the same. The price per engine and the warranties are the difference. That's the difference between the two products. And it doesn't take a Nobel Prize winner in economics to figure out what's the reason for this. The LA engine has a cost of $25,000, $7,000 more than the California engine. That means that engine, because being more expensive, is going to be more efficient. Thus, notice the warranty cost per unit for the LA engine. It's only $500. They don't anticipate that failing as much as the cheaper engine of $18,000 for California. Look at the warranty there. 2 clams, $2,000. They're anticipating a lot of inefficiency in that cheaper engine. The whole premise of the case for you as a finance student is to determine if you're spending more on the LA engine, are you creating greater value than if you go on the cheap and get the LA engine or the California engine. That's the crux of the analysis. I'm looking for you to prove it to me via a capital budget analysis spreadsheet and an interpretation and answers in your paper. This is the basis of all corporate finance. We have an idea for a market. Our marketing people, our manufacturing people, our sales people, our R&D people all say we got to get into the mass transit bus market. Okay, I'm the finance dude or dudette. Prove it to me. What is it going to cost us? What are the revenues? What are the risks? How much do I have to need to invest in? How much is my cost of capital? Boom. There you go. And I know this is going to sound corny, and I hate it. I used to hate this when professors said this, but they were exactly right when they said it to me, because I knew, because in 10 years after I took this class as a 19-year-old goofy student at St. Lawrence University in upstate New York, where I went to undergraduate school, my professor told me, you guys aren't going to pay any attention to this, what you're going to do, but trust me, in 10 years, you'll be working for a company or working for yourself, and you're going to need to know this. A banker is going to say, oh, you're starting a new company? How much capital do you need? Tell me, how soon are you going to get to profitability? What's your return on investment? What's your net present value? Huh? What? You're going to do it. Or if Ben ends up becoming an HR director for a corporation, and one day Ben is in an HR meeting and they're thinking about opening up a new plan and hiring new employees. And somebody's going to say to Ben, we have to watch our employee cost, because then we're going to exceed our capital budget estimates for this project. I think it'd be a good idea if Ben knew what the hell that person was talking about. You're going to use this in many shapes and forms down the line in your professional career. Maybe not right away, but trust me, if you're in a business that's not even for profit, it could be not for profit. If you're willing and want to invest in a new market, a new asset, you got to know what this stuff means. You don't have to know about calculating it. You're going to have other people do that, but you're going to have to know what it means. By doing this analysis here in this class and writing a paper about it, you will know what this means. Okay? So as I said earlier, if you look at the exhibit, am I recording this? Yes, all set. You know, excuse me if you look behind me, tonight's a big night. First of all, baseball is in its last week of playing, because they're going to cancel the season about another week anyways. But baseball is behind me, and then also the NHL hockey season starts this evening. I've already watched one game today. There's a game on now, and there's another game on later. Now, I don't know about you guys, but I am a huge hockey fan. Why? I'm from Michigan. Why? I went to college and played hockey. Why? I like the sport. So it's a big day for today. A big day. All right, now that I've bored you with that. Now, remember I said earlier, the key part of this analysis for California trucks is being able to distinguish the difference in return for the bus, the product, by knowing the difference between the LA engine and the California engine. And part of the big component of that is warranty. What's a warranty? You're estimating it that it's going to fail. If somebody's going to pay $220,000 for a bus, they probably want to have some good feeling that you go by the quality of this product. And if you go by the quality of this product, you're willing to pay if something goes wrong in the first 5 years of that ownership of that bus. 5 years, that's it. If the bus fails, engine problems, seats fall out, the brakes don't work, whatever, you can bring the bus back and either get your money refunded or, in all likelihood, get the problem fixed. That's a warranty. So many companies like California Trucks build into their costs the warranty cost. I'll say that again. They build into their costs a warranty cost. Now that's pretty easy to determine when your labor cost is $50,000 a unit, your parts are $95,000 a unit, your fixed SG&A are $250 million a year, your LA engine is $25,000 a unit, and your California engine is $18,000 a unit. That's right there, up and running in that year, no problem. For every year, years 1 through 20, you got to calculate that out. But this is what separates the A's from the A minuses. You have a 5-year warranty where it's costing the company every year of those 5 years per unit produced. And how many they're producing? 11,000 units every year. $1,000 warranty on the bus and another $500 warranty per year for 5 years on the LA engine and $2,000 a year for 5 years on the California engine. So let's lump those two together. $1,500 a year for 5 years for the LA engine bus and $3,000 per unit every year for 5 years. But these are going out 5 years. The matching principle of accounting tells me in order to reconcile cost with revenue, I have to match my expenses with the revenue in the year that that revenue is incurred. The matching principle of accounting. Isn't that exciting? So I can match up labor, parts, SG&A, engine cost in this year. But how do I match up the warranty costs this year when I'm producing and selling that bus, because those costs go out 5 years? Well, the case gives you a hint on how to do that. It's called present value. You present value those 5 years of costs into one number today. And that's your warranty cost per engine every year per unit for 20 years. You calculate that warranty and it's going to be the same every year. Now I'm missing a big part out of this, and I'm going to tell you what that big part is now, but I'm not going to say any more about it. You have to account for inflation in this as well. What's the inflation rate for this case? 3% across the line. 3%. In the assignment you just did, where is it? I believe the inflation rate was, what, 2%? God, I had it here a minute ago.
3%.
How much? 3%?
3%.
3%. Across the board?
Yes.
Okay, so it's very similar to the, God, why did I do that for? I should have made it a little bit more challenging. But be that as it may, it's very similar to the California Best Trucks case. So you have to establish the warranty cost per unit, taking 5 years of cost into one number. That's the challenge. Do that, stick it into your spreadsheet, and the spreadsheet will be very similar to the template that we've used in assignment 3 and all the others. Here's an example. You have revenue, sales, you have variable costs, fixed costs, depreciation. The only difference here is you're going to have to add a line here, an additional line, and call it variable cost warranty. The other variable costs can be all put in that line. But I want to see a separate line showing me variable cost per unit warranty and the dollars associated with that. That's the only difference. Everything else is exactly the same. I can't believe I'm telling you this. What a nice guy. So that's what you're doing in the California trucks case. I've given you a checklist in week 8, and you really should start working on that this week. Rest your brain for a couple of days, wait to get the results of assignment 3, and maybe in this weekend, begin to crunch these numbers. Get the numbers out of the way. I'm looking for one spreadsheet, not a PDF. I'll say that again, not a PDF. I'm looking for a spreadsheet with 3 tabs. Here we go, 3 tabs. Tab number 1, your weighted average cost of capital calculation. Tab number 2, your analysis, your base analysis for the LA engine. And tab number 3, your base analysis for the California engine. Those are the 3 exhibits that I need to see. Now, how you get those into your paper, don't cut and paste the whole friggin' spreadsheet into your paper. I won't be able to read it anyways. It's be too small. Try to encompass the numbers, maybe a summary page of your analysis, a summary table comparing the 2 engines in the return, whatever, but find a way of getting that into your paper. Don't just have a lot of writing. Show something. Be creative. Show a little chart. Show something. Two files, a Word or a PDF file for your writing, APA format, and then a spreadsheet file with 3 tabs, WAC, LA engine, California engine. That's what I'm looking for. And you can send me your WAC calculation. I will verify it. You can send me your base case analysis for 1 engine. Because if you get that engine right, you just copy that file and then adapt it to the other engine. There you go. Mr. Hassey, you make this sound so easy. And I know I'm going to start into this and it's going to take me 5 friggin' days to figure this out. That's okay, but that's what I'm looking for. Try to get the number crunching done in the next week or so and save the last week to write your paper because you're going to have an exam due that same week. And that exam will take you about 3 hours to complete. You can trust me on that one. So that's what I'm looking for. We will review this again next week in class, and we will review on Saturday, August 8th at noon via Zoom, a review session for Business Finance 330 to review this material and the examination. And next week, I will supply a financial examination outline of what to anticipate in your study guide for that exam. Okay? So that's where we're headed. Anybody, I hope all of you by now have at least read the case and the case material. Does anybody have any questions of me tonight in regards to this case? Okay, very good. Okay, now our subject for this evening. I've indicated in Blackboard some sections of the text that I wanted you to read in regards to each chapter. I'll be doing the same next week for the subsequent chapters. Matter of fact, if you go to week 9, you will see the sections you'll be responsible for in those chapters next week. You don't have to read all the chapters. I'm just concentrating on 5, 6, 7 pages in each chapter that is important for you to review and that we will review in class. So here are the sections from tonight's topics. Our topic tonight is corporate finance. Now, a lot of you already know about this. You invest in companies, right? A lot of you own stock. A lot of you own bonds. Wait a minute, Mr. Hassett, I don't own a bond. Well, you got money in a savings account? You got money in a money market account? You own bonds indirectly because the banks take your money in those accounts and buy bonds. That's what they do. The same thing with stocks. That's how corporations are financed in the market by getting capital from investors through banking institutions, through the stock markets, through the bond markets. They get this cash, they invest in assets, they make money, they do a capital budget analysis to verify that the plan for them making money is what it is, what they're going to return, what's their NPV, what's their IRR, what's their payback, etc. And then they raise the capital and invest in the assets. The profits that they make and the return that they make pay off that capital, dividends, stock growth, interest payments, principal payments on debt, and hopefully they make a little bit extra to return back into the company for further growth. Welcome to the world of corporate finance. But how you get funding depends on the quality, the efficiency, and the risk of your company. Banks aren't going to lend you money if you have a history of not paying on time. People are not going to buy your stock from the market if you're not making any profits or showing very little growth. Oh, wait a minute, Mr. Hassey. Amazon.com didn't make a profit for its first 10 years. People bought their stock. And even today, Tesla, just until the last year, never made a dime of profit either. Now they are, a little bit. But people kept buying their stock. That's exactly right. In the case of those two companies, people bought the stock not for a return of profit, for a return on the future value of the company in the marketplace. They bought Amazon, they bought Tesla because they thought they were on something big for the future. And boy, were they right, especially in Amazon. That's the second half of equity financing. Equity financing is not only, oh, please pay me a dividend, let's hope the stock goes up in price, but also I'm willing to wait a few years for you to get your technology, your market, your efficiency in line. And once you do that, then I expect to make my money. Microsoft and Amazon are the two most valuable corporations in the world today, this morning, this afternoon. They go back and forth, who's doing better. And the reason why they're doing so well is A, they're in an industry that people think is cool. Technology. Tell me any of you get up in the morning and one of the first things you do or not do is turn on either a TV, your cell phone, a radio, or whatever, and what do you want? Information, right? That's the first thing you do every morning. All of us, every person in the world. Microsoft and Amazon are providing that information. Wait a minute, Mr. Hassey, I thought Amazon just sold underwear and products, TVs. No, 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 no. Amazon owns 48% of the cloud. Whoa! Say that again. Amazon owns 48% of the cloud where all this information is. Damn. Exactly. Microsoft owns about 20% of that. Over 2/3 of all the information in the world is transferred through Microsoft and Amazon. Now you know why their stock's doing so well. It's technology. We get up every day and hit our cell phones. Information. Now, what other markets in the world now are like that? None other. Is Microsoft and Amazon losing money now? Is their stock going down? No. Even though we're in a pandemic, even though the economy has slowed down, even though we got a bunch of knuckleheads running this world, they're still making money. Why? Because we cannot go without 1 hour of getting information. There you go. And that's where the key to their equity financing is. People are saying, I'm going to keep buying that because for the next umpteen years, Microsoft and Amazon are going to run the show. Now, eventually, they'll not run the show anymore. Another company will come up. Is that company going to be Facebook? I don't know. I think Facebook's in big trouble with their privacy issues. Is it going to be Google? Nah, I can't see it. Now, they're still great companies. I think I might have mentioned this already in our class, but there's probably a company today, or excuse me, probably something today that has not yet been invented, that has not yet been created, that's going to be the new Amazon and Microsoft in 20 years. It could be farming on Mars. It could be whatever. If somebody told me 20 years ago that I would not have to go out of the house for the last 5 months and still have a refrigerator full of food, clothes, all my supplies, all my computers, and I'm talking to everybody in the world on the planet through my computer, if somebody told me that 20 years ago, I said, you've been smoking something. You got any more? What's going to happen 20 years from now? I have no idea. I'll be dead. You guys won't be. But what's that going to be? As equity financing, you're looking for those companies now. Maybe they're already out there and we just can't see them yet. Maybe the technology hasn't caught up to them yet and they're still developing. That's the great thing about equity financing. The unknown. What is going to happen in the future? Whereas debt financing is today. I'm borrowing money today to pay back in the future for money today. I'm issuing or lending money to a company to get paid off today. How am I going to get paid off today? Interest. How am I going to get paid off today? Principal payments. Yes, so it's going to spread out over a few years, but I'm getting paid today. I buy stock in Amazon today. I don't know if I'm going to get, the only way I'm going to get paid today is that I immediately sell the stock and hopefully it makes a profit in that day. I have to wait. With debt, you can wait. You don't have to wait. You're getting paid now. That's the difference between equity and debt financing. That's what's talked about in those sections. Okay. Well, let's take a look at these. Sec. Oh, sorry, guys. There we go. What is equity? Equity is ownership. What is debt? Debt is credit. You are a lender if you're an investor. That's debt. Equity is ownership. Debt is a lender, creditor. Right? So there's two values there, like I just said. The value in equity is you want the company to grow over time and you hold on to that stock and you grow with the company. Debt is I want to get paid back right now. Give me my interest payments, pay me my principal, pay me back. And I'll give you time to pay it all back, but I want to get paid now. That's the difference. So there's a different mindset when you go out and raise that money as a corporation. And what we're going to see after we come back from break at 7 o'clock, one of our poll question tonight is the difference between debt and equity. What's the difference? And it's the way you're paid. It's the way you get income, cash flow as an investor. And also for a company, you don't have to pay back right now stock ownership. You have to show that you got your act in gear and are performing. You're meeting all your estimates, but you don't have to pay anybody anything. You don't even have to pay a dividend if you don't want to. Eventually, you probably will. But with debt, you have to be prepared to generate cash flow to pay back today. Interest, principal. I don't know anybody, unless they have great credit, if you go out to your car dealer today and buy a car and say, oh, can you lend me the money to buy a car? Sure. What's your FICO score? 850. Oh, yeah. Here it is. Oh, okay, since I have good credit, do I have to pay you back? Huh? Do I have to pay you back? Yes, you got to pay me back. You got to pay me back the money in about 5 years. Now, I'm going to give you very cheap interest because you have such great credit, but you still got to pay me back. Even though you have the unbelievable credit, you still got to pay the money back. You have to pay the money back. That's debt. So that's one of the cardinal rules of investing or corporate finance is debt means cash flow. You got to have cash flow today or in near future to pay back that debt, interest, principal, whatever. You don't need the cash flow today with equity. It's just expectation of your investors. They expect you to do better in the future. They'll get paid then. Dividends, stock growth. But how is the only way you're going to get paid with stock growth is you got to liquidate. You got to sell it off. So debt is a different animal because you need to generate as a manager cash flow today. So if you're buying a car today, geez, I need a car. I'm getting sick of riding the Metro Link to downtown LA. I'm going to buy a car. Okay. So you buy a car. Oh, do I have to pay it back right away? I got great credit. Can I pay in like 3 years? Just all that? No. You got to pay me now. Here's a coupon book. I want monthly payments. Go. There you go. So that's the difference. And that's a key reason for understanding corporate finance. And there's a nice video in week 8 that kind of highlights that. And in your YouTube site is the difference between debt and equity. And that's the big reason. It's one of the reasons why we like to buy real estate. Because in real estate, yes, you borrow money, But as you pay that money back, you're building equity and ownership in the house. And when you pay all the money back, you own the house. You can now sell it and liquidate it and get all that cash for the value of the house because you own it. But did you get all that value when you bought the house? No, you got a lot of debt. The only value in the house you got was the down payment you put on the house. It's the same thing for corporations. Equity gives the return over a longer period of time as the company is hopefully successful. Whereas debt, you got to pay it back now. That's why on average, about 2/3 of most American corporations are in debt. The other third is equity. Why? It's easier to manage. Less expectations. You don't have shareholders yelling at you all the time. The only people you have yelling at you is if you miss a debt payment. Whoops. But you build that into your budgets. You build that into your operations. If you don't have enough money from income to buy a car, don't buy a car, because then you're going to lose it. If you don't have enough income or cash flow to buy a house and afford the mortgage payments, don't do it. You're going to lose it. Right up front, you know that. That's how you qualify for the loan. Oh, here's my pay stub. Here's my expenses. The bank will say, sorry, dude, if you take on this loan, you're not going to have any extra money. You're going to be, all your money is going to pay back things. We can't, you're sure you want to do that? No. That's the danger of debt. But if you can manage the cash flow and the payments, that's the good thing about debt. Okay, when we come back from break, we're going to have a little poll, and then we're going to look at problems in our textbook that highlight these things. The difference between debt and equity. The two main reasons of corporate finance. Shark Tank and that stupid TV show on CNBC, Shark Tank, is not how the world is financed. Trust me, and you guys probably know that anyways. These knuckleheads who think they're big shot investors. Matter of fact, the guy who calls himself Mr. Wonderful, that bald-headed guy, he's been bankrupt 3 times. So don't let him kid you. He's not that brilliant. Mark Cuban, all right, he's pretty sharp. The guy from Canada who thinks he runs the show, I know a couple of people personally who work for this dude. He's not too smart. So these guys aren't what you call, I don't take these guys as examples of corporate finance. It's a TV show. So we'll learn about that. We'll talk about that. Now that I've slammed CNBC and Shark Tank, sorry about that. But as you know more about finance, you'll go, oh, really? Who are these guys? What's the big deal? All right, so when we come back from break, we'll talk about that. We'll have a poll. And think about if you have any questions before the night is out on California Trucks case. If you have anything that pops up, if not, we can handle it later. We got 3 weeks to do this thing, so we'll be okay. All right, so I'll see you in, let's call it 12 minutes, at 10 minutes after the hour. Around then. Smoke them if you got them. I'll see you then. Adios. Okay. And so here are our answers based on our distinguished finance class. It looks like 82%, or 14 out of the 16 or so votes cast, was interest expense is tax deductible. And that is the correct answer. That's why debt is cheaper than equity. You can tax deduct it, part of it, based on your tax percentage, 22%, 30%, 40%, whatever. It makes it cheaper than equity financing. Debt is the cheapest form of financing. If you've seen in any of your calculations thus far in class, you've always noticed that debt is the cheapest rate. Debt decreases fixed costs? No. Matter of fact, debt increases fixed costs. What's a fixed cost? Interest expense. So that's incorrect. Stocks have a higher return than bonds? Yes, but that has nothing to do with you paying for it as the company. That has everything to do as an investor. And also, over the last 8 years until the pandemic, bonds were doing better than stocks. Certain bonds. But that has nothing to do with the cost of the financing. It has everything to do with the investment return for the investors. So the correct answer is interest is tax deductible. That makes debt cheaper. You cannot deduct on your taxes dividend payments. You cannot deduct on your taxes the change in the stock price, the capital appreciation or depreciation. You can deduct interest, and that's what makes it cheaper. So that's good. That's why a lot of companies borrow money. In the long run, it's cheaper than issuing equity. But you can only borrow up to a certain point, and then the risk becomes too great and your interest rates go up. If you're 80% funded by debt, that's going to make your interest very expensive. So you only can do it to a point, then your alternative is issuing stock. So thank you for doing that this evening. Well done. Okay, I now are going to turn to our textbook, page 437. At the end of chapter 14, there's a nice little exercise that is good for the study and the knowledge of equity financing, corporate financing. Problem 4 on page 437 of your textbook, and here it is right here. I'm going to take a few moments to look at it because I'm going to be going around our internet room and asking you, some of you, for your opinions on these answers. I'm going to go around the internet room and ask some of you your information. So please take a moment to read this problem 4 on page 437. Match each of the following terms with the correct definition. The price at which each share is recorded in the company's books. Held by investors. Cumulative amount of profits that have been plowed back. The difference between the amount of cash raised by an equity issue and the par value of the issue. The maximum number of shares that can be issued without shareholder approval. The amount that the company has spent buying back stock that it has not subsequently resold. All key points of equity section of corporate financing. The answers on the left are to those sentences that we are matching. Good definitions of finance that you'll see in assignment number 4 in a week's time. Ben Avila. Ben, are you there?
Okay.
Hello, Ben.
Hi,
How are you this evening?
I'm good. How are you?
Good. Anything new and exciting in your life you want to share with us?
A lot of movement at Budweiser.
I beg your pardon?
A lot of movement.
You're breaking up, Ben.
Ben has really bad internet connection.
Ben, you have a bad internet connection?
It's just my input is messed up.
Okay, Ben, we'll pass on you this evening. Sorry, but that's okay. No problem. Deandra Rubio, talk to me.
Hi.
Hi, how you doing tonight?
Good, thank you. How are you?
Good. Anything new and exciting in your life you can share with us?
Nope, nope. Just
Okay.
another day, another dollar,
Oh.
another lecture.
Another lecture. Okay. Deanira, the price at which each share is recorded in the company's books. The price of stock at which each share is recorded in the company's books is called the
Par value.
very good, the par value. The par value. Excellent. Let's do letter B. Held by investors.
Isn't that retained earnings?
No.
Oh.
Held by investors.
Issued and outstanding.
Issued and outstanding. Excellent. Very good. Miss Rubio, you've done well. You can turn off your mic, and I appreciate your assistance.
Thanks.
Anita Newland, come on down.
Hi,
Hello, Anita. How are you this evening?
I'm good. Yourself?
Good. Is everything okay in the Newland household this evening?
Oh yeah, crazy as usual.
Okay. Let's take a look at this. Letter C, Anita. Cumulative amount of profits that have been plowed back.
Limited amount of profits that have been held back.
In other words, profits that you keep and are held by the company.
The retained earnings?
Exactly right. Retained earnings. Retained earnings are the net income or profits that you make. Then you pay out some dividends, and whatever's left over, you get to keep in your company books as retained earnings. Very good. Let's do letter D, Anita. You're on a roll.
Oh my gosh. Okay.
I didn't know that was that exciting. The difference between the amount of cash raised by an equity issue and the par value of the issue.
Is it additional paid in capital?
Correctamundo. Very good. Additional paid in capital. In other words, if I sold a share of stock in the market at $10 a share and the par value of the stock was $2 a share, that means I've made in excess $8 a share, and that is called paid in capital. Very good. Anita, wonderful. It's been a pleasure.
Thank you.
We'll talk to you later. Dustin Keith, come on down.
Hi.
Dustin, how's it going tonight?
Good, thank you. And you?
Good. Dustin, a key question before we get going. Dodgers or Angels? What's your favorite team?
Angels.
That a boy. Ooh, you are on my good list now. Good
That's
job, Dustin.
Oh.
Even though the Angels are not going anywhere this year, still, they're a fun team to watch. Thank you. Good job, Dustin. All right, let's look at letter E, Dustin. Maximum number of shares that can be issued without shareholder approval.
The authorized share capital.
Very good. Authorized share capital. Excellent. See, these American League fans are pretty sharp. And finally, the amount that the company has spent buying back stock that is not subsequently resold.
The treasury stock.
It's called a treasury stock. And this is a big deal in a lot of American companies today, 2020. A lot of companies are still making profits, not as much profits as they're used to, but they're still making money. And what are they doing with those profits? They're buying back stock. They're going to the market and buying back the stock that the shareholders own. They're reducing the number of shares outstanding, which is going to cut back on the amount of dividends they have to pay out. And also it forces up the price of the existing shares in the market because there's greater demand. And that's what they call treasury stock. Dustin, I appreciate your help tonight. Thank you very much.
Thank you.
Okay, good job, guys. Now, one last one, and it's kind of along the same vein of what we just talked about stock, and I'm not going to have you guys do this so you guys can relax. It's the next question, letter 5. The authorized share capital of
You muted yourself. Professor Hassey? Yeah, you
Got it. Thanks, Dustin. So let's look at, there we go. Let's look at the question number 5 on page 437. Alfred Cake Company is authorized to issue 100,000 shares. Here's on their company's balance sheet financial statement is their current equity section. They have $1 par value stock valued at $60,000. They have additional paid-in capital of $10,000. They have retained earnings of $30,000. Thus, they have a total common equity position of $100,000. Then they have purchased back 2,000 shares of treasury stock at $5,000. Thus, they get the equity balance of the company of $95,000. For you accountants in the audience, $60,000 would be a credit to common stock. $10,000 would be a credit balance to additional paid-in capital. $30,000 credit balance in the retained earnings account, and a debit balance of $5,000 in treasury stock. My first question, and again, nobody has to answer this, but if you want to be aggressive, Joe Regas, chomp in. Anybody, if you think he can do the answer. The first question, how many shares are currently issued today by the company? Well, the answer is 60,000 shares. Because why? Each share has a value of $1 on the books. There's a $60,000 balance in common stock. That means 60,000 shares are issued and outstanding. Now, they can go ahead and issue up to 100,000 shares of stock to raise additional capital. They can issue additional 40,000 shares of stock. But as of today, there's 60,000 shares of stock issued. How many shares of stock are outstanding? Ooh, a trick question. Well, if we have 60,000 shares issued, but the company has bought back 2,000 shares of stock in the market, meaning they've gone to the market and bought 2,000 shares back from those investors, that means our shares of stock that are outstanding are 60,000 minus the 2,000 buyback. 58,000 shares of stock are currently outstanding in the market, owned by the market. We have a chat question. Oh, Elena, thank you. You answered it. I should have checked that earlier. Very good, Ms. Guzman. Thank you. Elena says 58,000 shares. Thank you very much. And the last one, letter C, how many shares can be issued without the approval of the shareholders? Well, the answer is they can issue they've already been authorized to issue 100,000. They've issued 60,000 shares. They bought back 2, but still that's 60,000 shares that have been issued. Thus, they can issue another 40,000 shares of stock without additional approval. Now, if they want to issue 110,000 shares, that means they got to get approval from the board, from the shareholders for another 10,000. But now they can go ahead, the management can declare and go after additional capital of 40,000 additional shares. So there's some definitions of equity, pretty simple, but something we should all know about the equity position of a company. The equity position of a corporation is made up of 4 accounts: the par value of the common stock, any additional paid-in capital from the issuance of that stock, retained earnings, the profits they've accumulated and held, did not distribute, and the stock that they've bought back in the market called treasury. If you look at any company's balance sheet, major corporation, you'll see those 4 accounts. Very good. Okay. Now let's skip on over to chapter 15. Let me get organized here. Erica, you're first up on this one, so be ready. Get all lit up. So I'm going to go to chapter 15 now. Hang on. Let's bring that up. Okay, I'm on page 456, problem number 7. Page 456, at the end of chapter 15, which is also about equity financing. It's a true-false question. Give you a chance to read it, Erica and others. True-false. 3 questions. Let's see if we can do this. I'll give you a couple minutes to read it. And then Erica, I'm gonna have you open up your mic and you can tell me the first one. A, is it true or false? So take your time and then let me know when you're ready, Erica.
So the question is, venture capitalists typically provide first stage financing sufficient to cover all development expenses. Second stage financing is provided by stock issued in an IPO. I'm going to say true.
The answer is false. False.
Because the IPO is the initial public offering?
Exactly.
So not the angel investors.
No. The answer is venture capitalists will usually invest a portion of the operating costs and require managers to also invest. In other words, a shared investment. When second stage financing is required, they usually offer to provide this under the condition they receive additional equity financing. That's a fine line there. That's I would accept true on an exam. I'll tell you that right now. But the book says it's false, and I can see why they're being a little picky about that.
Yeah, I was thinking of angel investors and like
Yeah.
the video that was on the Blackboard.
Yeah, exactly. And also on Shark Tank, when the Shark Tank, the Mark Cubans of the world they're the venture capitalists. And when they go in to invest in a company, they're investing in giving them more capital so they can expand the business. The managers or the people who are there at the Shark Tank show already have invested money into the company. The second stage of financing would be to provide a stock issued in an IPO, but that's a fine line. Guys, for future reference, let's go true or false on this one. But I agree with Erica. There's a significant argument there that can be made for that. But let's give another one, Erica. You can do. Let's do that letter B. Underpricing in an IPO is a problem when the original investors are selling part of their holdings. True or false?
Mute. Okay, not mute. I'm going to say false.
Exactly right. False is correct because Let me explain that for some of you. Underpricing in an IPO is, let's say, you know how an IPO works, and they explained it in some of the videos if you looked at them. An IPO means you place a value on your company. You go to the market, you hire an investment banker, and let's say they say my company is worth $1 million. Okay, and so they decide, okay, so the investment banker said, okay, let's go out and raise $1 million. That's what we think it's worth. Okay. And so they said, okay, let's issue 100,000 shares at $10 a share. All right. Now, really, in the investment bankers and even the management team probably think this company is really worth maybe $2 million. They underprice it because they want it to sell out. Thank you, Christine. So because of that, then they go out and underprice. But the thing about that is it has nothing to do with the value of what the money they're going to get. They're just trying to play the market and trying to make a profit on the deal, because what they do is when they issue the IPO stocks, then they reissue them to the secondary market, and that's where they make their killing. So it's a false statement. Very good. And now I was going to pick Catherine, but I just got a chat that Catherine had to leave for her child. So Erica, why don't you take letter C and finish it up? Stock price generally falls when the company announces new shares. This is attributable to the information released by the decision to issue. In other words, if I have stock and now I'm going to issue more stock, they're saying that the stock price usually falls. True or false?
I'm going to say false.
No, it's true. Okay,
Oh,
that's usually what happens, is because of that it's now diluting the market, and there's more, unless
less demand.
it's right. And so the price will drop because of that. That's exactly right. So those are a couple.
Kathy's
Yeah.
hotspot isn't working.
Yes, I saw that. I saw that. So that's why I was going to call her next, but I saw that chat session. That's okay. So a couple things to note out of this little problem. Venture capitalists are private investors, and they usually fund a company before you actually go out and get public stock. A venture capitalist is Mark Cuban. A venture capitalist is LeBron James. I'm a venture capitalist to a small extent. I invest in some startup companies. And why do I do that? Because I hope eventually the company will go public, and then I can cash out and make a ton of money. That's what you do. So if you're LeBron James, if you're Mark Cuban, you invest $1 million in a business, and if the business is successful and starts growing and they need more capital, they'll now value the business in the market, and let's say they're going to get $2 million back. They'll double their money because the value of the company has increased with their original venture capital. And again, the definition of IPO is initial public offering. That's the initial public offering of a stock. Okay. Let's move on to the next one. We're now going to go to chapter 16. Debt. I'm going to have you guys do this one. I'm on page 495. Excuse me. I'm on page 495. Problem 19. Leverage and the cost of capital. Let's take a look at it. A company by the name of Doucette, I think that's how you pronounce it, is financed 30% debt, yielding 8%. Now, we all know from our work prior that when it says yielding, that's the cost of the capital. The cost of the interest rate on that 30% is 8%. Investors require a return of 15% on Doucette's equity. What is the company's weighted average cost of capital if the corporate tax rate is 21%? tell me what's the WACC for this one. Vince, I'm looking for you, buddy, to lead the way. 8% cost of debt. 30% of the company is financed by debt. Expected return on the equity is 15%, and the company's tax rate is 21%. What is the WACC for this company? Take your time.
Hey, Professor, I can't find where my interest rate on debt is. I'm looking at the,
Right here, debt yielding is 8%. That's the interest rate on debt.
okay. So I've got my tax rate at 20%, my interest rate on
21%.
tax rate at, okay, tax rate at 21%. Okay, I've got my rate on debt at 8%. Let's see. Take my C15, which is right here. Okay, so I'm taking my debt to assets.
If the company is financed by 30% debt, what must be their equity position?
That's going to be 70% equity with 30% debt. So then
Very good.
now I take those and I'm multiplying my, let's see. So I'm going to multiply that by the debt,
After tax cost of debt, right?
right? Okay. Okay. All right, I'm almost done here.
All right.
0.08 times. Okay, so I'm going to take the 0.08, which is the 8% yielding debt.
Yep.
Now I'm timesing that. Well, first I'm going to take 1 times the tax rate of 21%.
Right.
So we got 1 minus 0.21 in parens times 0.09, or excuse me, times 0.08.
Okay.
All right, I'm gonna put that in my calculator really quick here, sir.
Take your time.
Times 0.08. Okay, so I'm looking at 63%. My answer for figuring out my, excuse me, 6.3. 6.3%.
That's your after-tax cost of debt,
Right.
right? And your cost of equity is 15%.
Okay, and then I'm going to multiply those two.
Right.
And let's see, so I got 0.15 multiplied by 6.3.
No.
No.
All right. Anybody else? Hang on, Vince. Anybody else got anything? No? Well, let me show you. I'm just using our spreadsheet from prior class. Here it is right here. So I have, oh, here we go. Somebody has an answer. 12.4%. Very good, Carl. And here's my calculation. Good job, Carl. I have 8% interest. That's my yield on my debt. I have 21% tax rate. So 8% times 1 minus the tax rate is 6.32%. You were right there, Vince. And my cost of equity is given, without all the regular razzmatazz calculations, is 15%. If my debt position is 30%, 30% of 6.32 is 1.9. If my equity position must be 70% times 15% cost of equity, 10.5, add the two together, 12.4% is my WACC. That's the answer. Okay. A little bit different way of looking at it in this problem. So I was looking for you don't have to worry about the capital asset pricing model. That number is calculated for you. You have to determine the after-tax cost of debt, and you have to determine the amount of equity position in the company. When they tell you that the company is 30% debt financed, that must be the rest of the financing is coming from equity. Fill in, do the arithmetic, 12.4%. The reason why I'm showing you this problem, you might want to highlight it, is this is how I might ask this question on a final examination. We've done this before, but in this case, in this example, it's done a little bit, the numbers are given to you a little bit differently. And you have to sort out, based on our knowledge and expertise in practicing WACC before this in this class, to sort this out and come up with the answer. This is an example in a couple of weeks of a final examination question where I give you something that you've seen before, but it's given to you a little bit differently. And you have to be able to sort that out with the inputs and the information given to you. So that's why I selected this problem. It's good practice for that. 12.4% is the answer to question 19. Okay, very good. So just going back to the problem one more time, so you've seen that. In chapter 16, the company is financed 30% with a debt yield, that's the interest costs, 8%, return on equity, tax rate, what is its WACC? 12.4%. Don't worry about question B. That doesn't mean anything. That's kind of a dumb question. So that's something like that I wanted to show you, and I will put this answer in Blackboard so you have it, see how it's done. And that's something a little bit different, and it's confusing and understandable. But if you know the true definition of what WACC is, you can sort that out and determine it. Very good. Okay. All right. Now, I'm going to show you one last thing, and we'll call it an evening. We'll go back to our Blackboard site. Just a sec. Here we go. This is our Blackboard site. Don't forget this checklist in week number 8. There's another template there of the capital budget analysis, and also I'll put the answers to assignment 3 as soon as I get all the work in, which will be tomorrow probably. But now I'm going to jump ahead to next week's file folder, week number 9. And in that file folder, in my introduction, I give you the 3 chapters we're going to talk about next week, 17, 18, and 19. And these sections you'll be responsible for in your reading, not the entire chapter, but chapter 17 is about dividends, how companies pay dividends. Section 17.1, 2, and 3 you'll be accountable for. In chapter 18, it's about financial planning. And I'm going to ask you to read section 18.2 about financial planning models. And chapter 19 is about long-term financial planning. And sections 19.1, 2, 3, and 4 in regards to capital planning, cash budgeting. I'd like you to be responsible for that, and my lecture next week will involve those sections. Assignment number 4 is on chapters 14, 15, 16, which we talked about tonight, and 17, 18, 19 next week. We will not get to chapter 20 next week. That'll be at another date. Okay. I also will post tomorrow in the Zoom YouTube links file folder the link to our August 8th review session, so you have that, along with our class recording of this evening. And with that, anybody have any questions or concerns?
Please, really quick, Professor Hasse.
Yes.
So regarding the California project that we're doing, California truck project.
Yes.
When you're talking about the warranty and how much of a grade, how much weight you're putting on top of that warranty, don't we have to have some type of knowledge on the strength of those engines and maybe the history of those engines to be able to apply a reasonable conclusion on the warranty and whether or not we should move forward with it?
No, you're yes and no, but no, Vince, in this case. Now, if you were in graduate school, yes. But in this case, the risk And the issue of the quality and the efficiency of the product is shown in the warranty cost estimate given to you in the case.
Okay.
$500 for the LA engine, $2,000 for the California engine. By it being $2,000, that means the company anticipates quite a lot of risk with that engine of failure.
Got it. Okay.
Make sense?
Absolutely. Thank you.
Okay. Very good. Good question. Now, if you have not already done so, sports fans, please go ahead and reread that case and make sure you understand it, and then begin to put the puzzle together in that timeline that I gave you, that checklist. Try to do the WAC by this weekend. We just did a practice of the WAC. We've done it in assignment 3. We've done it in week 7. You have a lot of templates to figure that out. Your job is to take a look at exhibit 3, financing assumptions. And with that information there, you can determine WAC. See if you can put that together this weekend. If you're a little fuzzy on it, send it my way and I'll verify it for you. Once you get the WAC, then you can proceed with the rest of the problem. Okay? That's something you should accomplish. Get that out of the way. Get these numbers out of the way early, especially while they're somewhat fresh in your mind. You just finished assignment 3. You kind of got a feel for that a little bit now. Now let's get those numbers out of the way, and then you can worry about the paper in another week or so. Any other questions? All right. That's it. Thank you again for this evening. Be well this next week. I will be posting this video of this lecture tomorrow morning. Have a great rest of the week. Be safe. Be well. Good luck with your work. Again, no graded work this next week. No graded work due till this next week. So you have some time to get caught up, even relax, maybe do some busy work with the California trucks case, get that going. You got less pressure this week. Then get ready for the last 2 weeks where hell comes at you. No. All right, everybody. Have a great week. We'll see you all.
Take care.
Good night, Elliot. We'll see you all next Tuesday. Adios.
Good night, everyone.
Good night.
Good night.
Good night, Anita. Thank you for your help tonight.
Oh, thank you. That was fun.
Good night, Lupe. Go Halos, yes. Very good. With a hockey game back in the background, we're back to normal. Calgary versus Edmonton, all is well in the world. Adios.